On March 30th, 2026, a sudden and violent wave of selling pressure completely submerged the Indian equity markets. The BSE Sensex plummeted 1,635 points, a 2.22% loss. The Nifty 50 dropped 2.14%, and Bank Nifty shed 2.43%. The India VIX surged to 27.89, triggering massive capital flight as foreign institutional investors pulled $13 billion out in March. This index-level devastation is the visible wreckage of a highly structured macroeconomic chain reaction. Emerging market sell-offs follow a predictable mechanical transmission of external supply shocks. To understand this specific crash, we must map out the economic machinery using a causal loop diagram. We will trace the path from a Middle East conflict down to the collapse of domestic banking and aviation stocks. This step-by-step causal chain provides a framework for distinguishing between structural victims and companies experiencing temporary regulatory friction. Escalating geopolitical tension in West Asia acted as the exact spark that ignited a rapid global economic chain reaction. The sudden escalation in the US-Iran conflict abruptly removed critical energy supply expectations from the global market. The mathematical result of this tension is plotted here. Brent crude surged past $115 per barrel as supply constraints materialized. This price spike strikes directly at India's specific vulnerability as a massive net energy importer. Inflated oil prices mechanically strip away national dollar reserves required to cover the soaring import bill. Simultaneously, this triggers a global risk-off environment where international capital rapidly retreats from perceived emerging market vulnerabilities. An energy price spike of this magnitude ensures a severe currency crisis before a single domestic stock trade is executed. Tracking the oil shock directly to the currency markets, intense downward pressure is immediately applied to the rupee. The currency drop reached an extreme limit. The rupee hit an all-time intraday low of 95.22 against the US dollar. Shift the perspective to foreign institutional investors observing this rapid depreciation. They face a mathematical double hit: elevated geopolitical risk to their underlying assets, combined with guaranteed losses on their returns due to the weakened rupee. The institutional reaction is a massive rotation out of Indian equities. The quantitative damage is definitive. FIIs extracted $13 billion in the month of March alone. This sudden capital flight creates a highly destructive feedback loop. Selling local assets for dollars further weakens the rupee, mechanically accelerating the very currency depreciation that the foreign institutions are fleeing. This self-reinforcing loop forces the central bank into a corner, compelling them to intervene before systemic liquidity completely evaporates. To arrest the currency freefall, the Reserve Bank of India stepped into the market as a stabilizing force. We can observe the precise mechanism of intervention here. The RBI tightened forex position limits for banks to a strict maximum of $100 million. This policy achieved immediate success. The rupee recovered from its historic lows to close at a stabilized 94.78. However, this introduces the concept of regulatory reflexivity, a dynamic where the cure for one macroeconomic symptom induces a severe localized shock elsewhere. The RBI successfully stabilized the national currency, but the restrictive $100 million limit mechanically choked liquidity in the banking sector. Looking at this Nifty 50 table, we can observe how the macro shock split the broader market into two distinct halves. The devastation was heavily concentrated in the financial sector. Bajaj Finance dropped 5.01%, SBI lost 3.94%, and Axis Bank fell 3.65%. These severe banking losses connect directly back to the RBI's strict forex liquidity clampdown. Meanwhile, Interglobe Aviation suffered a massive 3.81% drop. This collapse in the aviation sector traces straight back to the $115 Brent crude spike, systematically destroying jet fuel margins. Shifting focus to the green side of the table, pure play commodities posted solid gains. Hindalco rose 2.46%, alongside positive moves from Coal India and ONGC. These commodity stocks rallied logically on the back of surging global energy and materials pricing. Additionally, IT exporters like Tech Mahindra functioned as a natural hedge against the depreciated rupee, logging a 1.66% gain. The broad 2% index drop masks a rational, sector-specific repricing based on a company's mechanical exposure to oil and currency. To gauge current sentiment, we must look outside the equity markets to observe where that $13 billion in frightened capital is seeking safe harbor. This chart reveals the stabilization in alternative assets, with gold trading at roughly 14,728 rupees per gram. Silver pricing is also holding its ground, establishing a floor at approximately 2,45,000 rupees per kilogram. Pointing back to the India VIX holding elevated at 27.89, it is clear that institutional fear has not subsided despite central bank interventions. The combination of high commodity floors and an elevated VIX indicates that the market enters the new financial year under sustained pressure. Indian markets will remain closed on Tuesday, March 31st, in observance of the Mahavir Jayanti holiday. This trading pause gives institutional investors a critical 24-hour window to recalibrate their portfolios for the new 2026-27 financial year. The mechanical chain is now complete. Geopolitics drives commodities, commodities crash currency, and currency triggers capital flight. Ultimately, secondary central bank reactions dictate which specific sectors will survive the primary shock. Navigating the coming financial year requires modeling both these primary external shocks and the resulting secondary mechanical regulatory reflexes. Surviving these future financial years demands a thorough understanding of the precise, unyielding macroeconomic machinery behind every sudden market collapse.